You are listening to Revealing Real Estate Podcast, where we dive into getting over your fear of taking risk in real estate and making money while you sleep. I'm Nico Pedizano, your host and real estate guru with over 20 years of experience. It's time to get real. Wow, you guys are going to be in for a treat today. I want to welcome back on the show for a second time two very special guests. These guys went viral on my Instagram page and TikTok page with over 500,000 views. It's the most viewed video that we've ever received on Revealing Real Estate, and with high demand and with a viewership requesting these individuals to come back on, who specialize in account tax services, corporate reorganizing, estate planning, and help advise business decisions, part of the Valente Pacitti group. Please welcome back Marc Colasanti and Matthew Durante to the show. Guys, welcome back to this show. This is exciting to have you guys back on.
Thanks, Nick. Yeah, we're excited, and we're just happy that people enjoy listening to your podcast and hearing what we have to say. So thank you.
Yeah, no problem.
It's good to be back.
Yeah, glad to have you back, Matthew. So this is going to be wonderful. We today are going to be talking about an introduction to PRECS. Back in October 1st of 2020, REBA, which is the Real Estate Business Brokers Act, announced that they were going to allow realtors to open up PRECS, which was awesome. Back in the day when I started in business 20 years ago, that opportunity wasn't available to me. So just to put in reference, every transaction or a commission check that I earned went personally directed to my name. So every time I had to file my taxes were filed personally. Nowadays, a PREC is available to us to incorporate or open up a PREC company for realtors. I already personally had one prior. And before to be incorporated within the real estate business, you had to be a licensed broker to do that. And now as a sales representative, we have those opportunities, or my agents even on my team, our sales representatives have that opportunity to go open a PREC. So for those that don't know what a PREC is, I guess Matthew, we'll start with you. Can you explain what actually is a PREC?
Yeah, that's a good point. So to expand a little bit on what you said, so prior to October 1st, 2020, as a real estate agent, you were not allowed to have a corporation. So you weren't allowed to be incorporated. So you weren't able to benefit from many of the traits and advantages that corporations can provide to you as a professional, right? Because accountants were allowed to incorporate, doctors were allowed to incorporate, dentists, all were allowed to incorporate, but real estate agents were not. So prior to that, you were just self-employed, and all the income you earned, like you said, was taxed at the high rate of tax if you were earning a lot of money as a personal real estate agent. Okay, so you were paying, if you earned anything over $220,000, you're paying tax at the high rate, which is 53%. So every dollar earned after that, you're giving 53 cents back to the government, right? So a lot of money.
So just in reference, what you're saying is, if I earned a commission check of $10,000, just to break it down, and that $10,000, if I took that income personally, I'm paying 53 cents. I'm keeping 53 cents, or I'm paying back 53 cents back to the government?
You're paying 53%. So I'm saying marginally at the highest rate, if you're a real estate agent, like personally in the personal tax brackets, if you're earning $10,000 above $220,000, you're paying 53% tax on that. So you're only taking home $4,700.
Right, exactly.
That, right?
Okay, perfect.
So there's that. So then now after October 1st, 2020, you were allowed to incorporate. So now you can have the many benefits that I was saying before that everybody's allowed to have as a corporation. So realtors can now incorporate, and now all the checks you earn would go into your corporation. So there's a few benefits we'll talk about throughout the show, but I mean, one of the main ones, you're able to benefit from tax deferral now. So you don't have to earn all that income personally. So you can pay yourself a salary or a dividend from the corporation and kind of determine how much money you actually need to live. And then by having that amount of money, you need to live for your disposable income, you can pay less tax by benefiting from the smaller marginal rates for less income. Right?
Yeah, which was a great opportunity, right? Because a lot of times you weren't able to defer your taxes, and if I had that early on within my career, I'd be, it would be a lot better for me, right? Because everything then runs through my PREC, through my corporation. And then I'm able to, a lot of the benefits on that, and I think we'll tap into that a little bit more. Maybe Marc, you can expand on that. But just to understand is that everything on my phone bill, my tax bill, my car payments, my insurance, everything now runs through my corporation. And now from the corporation, instead of taking all that money personally, I run it through to the corporation. The corporation pays less tax on that commission check. And then from that perspective, I then run all my expenses through through that PREC.
Exactly. So all the expenses that relate to your business, to your real estate business, you can have that in your corporation so that you're not getting taxed fully on all this income if you don't need that much income to live. Right. So if you only need like $75,000 every year, as opposed to, let's say you're a real estate agent making 500 grand, you don't need to be taxed on that full 500 grand at the personal tax rates. You can just take out 75 grand as a salary from your corporation. So you can really control your income when you have a corporation now, whereas before you had zero control. So like if you made a sale at the end of the year and it was a big sale, then you're going to get taxed on the higher rate based on all the other income you had in that year.
Right.
Whereas in a corporation, you can just say, okay, this year I only need that $75,000. I'm going to pay that every single year until maybe I buy a new house personally. I need a little more money for a mortgage or something like that. You know?
Yeah. No, it makes total sense. So Mark, what are some of the advantages and disadvantages to a PREC? Are there any disadvantages into having a PREC open up?
Yeah, it's a good question. So one thing that a lot of people automatically assume is as soon as you incorporate, you're protected. No one can come after me as a shareholder personally. I'm not personally liable, but as a PREC, you still have duties and obligations to perform as a realtor. So due to that, if you were to, have negligence for something you brokered a deal or whatnot, you're still personally liable for that. So I just want, the viewers to understand that if you do go into a PREC, you as a realtor are still personally liable. But what you guys were talking about before in terms of, income tax deferral and how you pay yourself, one of the main advantages now of a corporation is how you can pay yourself. So one thing we always see with our clients is when they file their personal tax returns as realtors is they always have to pay into CPP. And, when you go give them their tax bill at the end of the year, you've made X amount of dollars, you owe $20,000 in taxes, and, you have to contribute, $7,000 CPP. And they say, well, I don't want to contribute to CPP. Well, you don't have a choice. When you receive personal income, if it's a T4 or self-employed income, you have to contribute into CPP. One of the main benefits of a PREC is that you can choose to pay yourself via dividend. So you can pull funds out of your corporation via dividend because you're a shareholder, and that wouldn't trigger any CPP.
Right.
Yeah. There also are some disadvantages to dividends as well too. I mean, like if you pay yourself a dividend, you're not really getting that deduction in your income. Mm-hmm. So if you have $500,000 of commissions in that 1 year in your corporation, you pay yourself a dividend. You're not getting let's say you're paying yourself a $50,000 dividend. You're not getting a deduction from your income of that $50,000. It's paid out of after-tax retained earnings, right? So that's something to consider too. So you're just bringing down the total value of your corporation and the growth you have. You're paying out of after-tax funds with the dividend.
Yeah. Right. But you're not drawing out a pay. You're not getting paid through payroll at that point in time. You're just taking out dividend every year. So you're taking a large amount of sum. And then you don't have to pay CPP to that.
Exactly. There's also more disadvantages just to paying yourself a dividend. Like for example, you won't be able to deduct childcare expenses against it. It doesn't contribute to your RSP room. And there's some more. So essentially, there are pros and cons, but that's one thing. At least it gives you the option as a realtor, if you just want to pull out maybe 30, 40,000 of dividends, because if you don't have any other income personally and you go draw a $40,000 dividend into your personal income, that's essentially tax-free personally.
Right.
Pending you don't have any other income. But, so there are some advantages to having that sort of ability to being able to choose how you want to pay yourself as a realtor.
So why do they call it a PREC? What's the definition of a PREC?
It's a personal real estate corporation.
So the PRECs are only for real estate agents at this point.
Correct. It's only for real estate agents. Like if you're a brokerage, like you're already incorporated, so the PRECs, they mean nothing to you.
Yeah. Correct.
Right? But if you're a realtor, nothing changes. Let's just kind of say that. Your duties and obligations as a realtor, that doesn't change.
Yeah,
you're still represented by a brokerage. You can only be paid by that one brokerage. Instead of it just going into your personal name, now it just goes into your PREC.
Mm-hmm. Yeah. Yeah, so having that personal real estate corporation too, I mean, like you have that like the main benefit of the corporation is just the tax deferral. That's the main advantage you have. And I mean, you can pay yourself via salary or a dividend, but the fact that you can control your income, like we were saying before, that's the main benefit. And we won't get into too much detail, like the actual, like the advantages of having the main benefit is just the fact that you can control your income and pass that along depending on how much money you actually need. Right?
Okay, so let's break this down, right? So a real estate agent earns on average, let's just say they make $150,000 in one fiscal year. Mm-hmm. They through that process, they open up this PREC that they get paid through the brokerage into their PREC. They've earned that $150,000, and now all the expenses go through their new PREC. And what would be the taxes based on that versus paying the taxes personally on $150,000?
Yeah, so that's a good question. So if you're looking at it within a corporation, so let's say your net commissions after all your expenses and everything, like your net income that you earn, let's say it's about 200 grand, right? So if it's 200 grand, now you pay, there's something called a small business deduction in a corporation. So you pay 12.2% on your income in a corporation for all income below 500,000. Income in excess of 500,000 in a corporation is taxed at 26.5%. So let's say you made $200,000, you're paying tax at 12.2% in the corporation, and then you also got to pay yourself a salary based on how much money you need personally. If you don't need any, you're just paying your tax on $200,000. So what is that? You probably have about, call it $40,000 of tax you're going to pay, and then the rest is just stays in your corporation. You can use that for other things as well too, which we'll get into. So you can use that money to kind of flow out to other corporations that you can use for investment purposes, let's say. So you don't have to pull that money out personally and then recontribute it in if you want to
you
buy
can get that money and reinvest it, whether you want to reinvest it into real estate. I want to buy some investment properties. Stocks, I guess you can open.
You can have an investment portfolio. Like the main benefit, like we were saying, is that buying power.
Is that buying power? Correct.
So if you have to pay out all that money, like let's say if you were self-employed, and you're getting taxed at 53%. If you made 200,000, 100 grand of that's going to the government, let's say, right? So you only have $100,000 to put towards a real estate property, right? Whereas in a corporation, you have like, call it 160 grand to go put away, or 180 grand, right? So that's the one benefit. And then also, if you're a personal real estate corporation, the only person who can own voting shares of that company is the real estate agent himself. So you can't put your kids on it or your wife on it as voting common equity shareholders, right? But you can have holding companies own shares in your personal real estate corporation. So that'll allow you to maybe move some funds up from your personal real estate corporation into a holding company, and you can own the investments up in the holding company per se, right? You can move those funds tax-free between corporations.
That's good to know. Are PRECs for everybody, all real estate agents? You think every real estate agent should open up a PREC? Are there kind of any guidelines that you would follow throughout that?
We get this, question all the time from our clients, and I see Matt laughing over there because we have this discussion all the time. But it really does depend on your situation, right? If you're a real estate agent that's making $300,000 a year, but you need $300,000 to live for your personal living expenses, there's no benefit to being incorporated. But if you're a real estate agent, you're making, even if you're making like $150,000
man,
a
if
year.
you got $300,000 of living expenses, man, you're living a high lavish lifestyle. I'll tell you that much. You're fucking partying.
Hey, we're in Woodbridge. I'm sure there's a lot of people with $300,000 expenses.
Holy shit.
But even if you're a realtor making $150,000 a year and you only need $75,000 to live, right? That $75,000 that you don't need to live, you can keep that in your PREC and you can get the benefit of the income tax deferral. Another benefit too is when you incorporate, that you wouldn't be able to do if you were just a personal real estate agent. Let's say you have a family, your spouse, you have kids, and let's say your spouse is in a lower income tax bracket, or maybe your spouse doesn't work because they don't have to for whatever reason, and they help you out with your day-to-day real estate activities, whether it's administrative or the bookkeeping and tracking your books and records and whatnot. You can go and pay a salary out of your PREC to your spouse and to your kids for helping in your business. So you're splitting income, and essentially the biggest benefit is you're benefiting at the lower marginal tax rates. So that's another thing too that we advise our clients. We always ask of their family situations. Are you married? Do you have kids? And as long as you're paying the salary that you pay, to non-arm's length individuals or related parties, as long as it's reasonable, as long as the salary that you would pay to a arm's length person, someone who's not related to you, the CRA, they won't challenge that, right? But if you go pay, let's say your spouse, $300,000 to go do some administrative work, they'll challenge that because you wouldn't go pay an arm's length individual that amount of money to go do that work, right?
Yeah.
In layman's terms, yeah.
So that's another benefit too that like our clients could take advantage of, and you're just splitting your income. Whereas if you had this money personally, you couldn't split that income with spouses or children.
Well, that's good to know. This is a great topic because I have a lot of real estate agents on my team when they first start out within the business. My advice to them is regardless, because there's a lot of new agents that are probably going to listen to the show right now and that have come on my team that just got licensed, and my advice to them is always, and I don't know if I'm wrong on this, maybe correct me if I am, you guys are the experts in this field, but to start right away to open up a PREC, whether you've made any money, and we'll talk about a little bit of the costs associated to that and how somebody can open up a PREC if they're a young agent who's just starting out in the business. But my advice to them is get into opening up a PREC right away if you can, because there are, for me, if I weigh out the advantages versus the disadvantages on it, the advantages based on opening up a PREC are a lot higher. So what's the process of opening up a PREC, and pretty much what are the associated costs to doing it?
Yeah. So it's a good point, Nick. So I mean, there are a lot of advantages to having a PREC as well too. And then you have to kind of do like a cost benefit analysis to see if those costs make sense depending on how much money you make as a realtor, right? Because if you're just a realtor and you're doing it occasionally, maybe you have like one deal a year, or even if you're just doing it part-time, let's say, it might not make sense for you to have that personal real estate corporation, because all that money you're earning, if you were just to earn it personally, you wouldn't really pay much tax on it, right? Because you're not going to have that much marginal rates. But to that extent that you're mentioning, like you could start, if you start building your portfolio of real estate and then you don't need that money, it could make sense to leave it in the corporation. You don't need to pull it out, right? So it all just depends on like what you're going to be doing with those funds. But if you don't have any other income and you're just a real estate agent, you're doing it part-time, let's say, and you're making about 10, 15, 20 grand a year.
Yeah, that doesn't make sense at that point.
But if you're making decent coin and it's moving up, you can start, if you're going to make a good amount of salary and a good commission from the real estate that you're doing, if you work with a good team, let's say, then it might make sense from the beginning to have a PREC going on, because then you can just benefit from that leverage of having that tax deferral early on, right? So that's one thing you could do. I mean, also another thing too, if you do get started, there's benefits to having like a corporation, right? So if you have a corporation, let's say you're the OP team and you have a lot of, like, there's a lot of brand with the OP teams. You have a brand, you have a customer list, right? So a lot of real estate agents think that there's not much value with their name. It's all just with them. And like, if you were to stop being a real estate agent, people would stop coming to see you, right? But you've built like the OP team itself. So there's a lot of value in that brand, and that, like, you have a customer list, right? So let's say when you're done being a real estate agent, you don't want to really deal with real estate anymore. You can maybe sell that customer list or sell that value and monetize that in a way where you can sell to another real estate agent. So you could sell your PREC to another real estate agent per se. And then now by having a corporation, you can benefit for not paying any tax, because you can use something called your lifetime capital gains exemption, right? By using your lifetime capital gains exemption, you have now it's about 970 grand in 2023, where if you sold your PREC for 970 grand to somebody else, you wouldn't have to pay any tax on that. But if you sold it personally, you would have to pay tax on that amount of money that the individual gave you to buy your customer list.
That's huge.
Right?
I didn't know that.
Yeah, so you can save, and that tax savings itself, depending on what rate you're in, is about 250 grand of cash, right? Because of tax savings. Yeah. So that's another benefit of just of a corporation. But yeah, I liked what you were saying about the cost. So it just depends on what you have in your personal real estate corporation. Sometimes we charge about, like, to do accounting services, about 2,500 to $3 grand, depending on what you have in the corporation. That's like a base fee per se. And then you also you're going to have some incorporation fees that you have to deal with the government and with your lawyer. So it's always good to use a lawyer to get it set up, to make sure that you're setting it up properly. You do that. And then if you're already operating, as a self-employed realtor, you may have some brand and goodwill that we have to kind of move that into a corporation, which is a little more complicated, but that's something you should do to safeguard yourself from CRA. So just moving that brand into the corporation. There's some vehicles to do that, but it's a little more complicated.
Good. Marc, did you want to add on that?
Yeah, no, it's a good point that Matt was saying. And, like he said, if you're a realtor who's been, you've been in the business, let's say 5 years, and, you've built up this brand and goodwill, and then you say, hey, I want to open up a PREC, I'm making too much money here. I don't need all this money to live. Just make sure you do consult like a tax professional, because essentially that brand and goodwill that you've built up to that point in time, it's called a rollover. You have to roll that into your corporation. It's called a Section 85 rollover. We don't need to get too technical, but essentially, if you don't roll that brand and goodwill into the corporation, the CRA can come and they can say, well, now you've sold that brand and goodwill to the corporation, and they can tax you on the accrued capital gain or whatever the value is at the date of transfer. So that's one way to safeguard yourself. So just make sure that, when you are opening up a PREC, that you are using a lawyer and accountant to make sure you're properly set up.
Enjoying this episode? Subscribe to our channel and leave us a comment down below to let us know what you want to learn next. Make sure you're following our Instagram and TikTok to stay up to date on our new episodes every Friday.
Is there any other topics that you guys wanted to kind of dive in on the PREC side of things still, that you feel that we're missing that are important?
One point I do want to make is that, we do have clients, and this is like, as you were saying, when should you incorporate a PREC? Does it make sense for me? So, a lot of times, like you say, realtors that are just starting out, open up a PREC. That's what you're saying. And to some regard, I do agree with you, especially if you're a young realtor, you're still living at home, you don't need that much money to live, and if you're hungry and you want to do well and you start doing well because, you're on the marketplace and you're making sales, it does make sense to incorporate, because you got to think about it, from the ages, let's say, you start a realtor when you're 24, let's say to 30, right? How much money do you really need to live, right? And if you want to start investing, your real estate, your accumulated cash flow and your PREC into other assets, you can do that through other sort of corporate vehicles, and you can benefit from the income tax deferral. So that's something else we kind of want to talk about is, the benefit of investing through your PREC.
Yeah. And then that's a good point. There's a lot of advantages to it. Sometimes you have to factor in too. So there's new rules where, like, if you have investment income in corporations, it's not always advantageous to have investment income in a corporation, because if you go over certain limits, so for example, if you have over 150 grand of investment income in a corporate group between associated companies, you can potentially lose your access to that small business deduction. That $500,000 that you have that you can get taxed at the low rates of 12.2%. If you have 150 grand of investment income in your corporate related group, associated group, then you lose access to that small business deduction for the next year. So you may not want to have investment vehicles in your corporation that generate that investment income, because then you're going to forgo the access to that small business deduction every single year. Right. So you want to keep that in mind. I mean, it's not, you can still invest in stuff in the corporations where assets in the corporations where they don't pay annual investment income per se. So you can buy, let's say you bought an investment property, right? And the rental income, maybe it's not cash flow, maybe it's not making an actual rental income, but over the years, you hold it for 20, 30 years. And then when you go and sell that, you're going to have a capital gain on that property, right? So you didn't have any investment income for 20 years. So you didn't lose any of that small business deduction because you didn't have any investment income. But now when you go and sell it, you have it all at one time. So you maybe forgo it for the next year per se, but you don't lose the advantage of that small business deduction throughout the 20 years.
Yeah, no, that makes total sense. I wish I had that early on. I remember when I started within my business and PRECs weren't available to me, and we didn't have a brokerage at that time. All the income that we made, of course, was definitely re-put back into real estate investments. But the real estate investments that I had to purchase were all through my wife's name and my name, right? So we owned it personally. Now, if I ever had to go and sell those properties as well, now I'm paying based on personal tax, capital gains tax on that. Whereas if I started out and had the opportunity to have in a PREC and I had all that or more liquid buying power access, right? Because I'm paying less tax through the corporation anyway than I was personally, I was able then to get that money, reinvest it back in the market, and then when I ever sell those properties, now I'm getting paid at the corporate tax, whether that be the 14% or the 12% that you mentioned, or the 21%, whatever that number may be. I'm paying a lot less in tax through the corporation than I would be personally.
Correct.
And there's a huge benefit to that for myself that I think is huge, and it's great that you tapped on that.
Yeah. We'll get into more like all this wealth that you're building in this corporation. You're building it at lower rates, and then we'll talk about the estate planning piece in a bit as well too. We'll touch on that, but I also just want to lead into what Marc was saying about the investments in the corporations as well too, because there's multiple investments you can make in a corporation, especially with real estate, right? So we touched on this last podcast a little bit too with the new rules, but I mean we won't get into those rules. But either way, so I mean you can have you can have multiple. You can have in your PREC, you can have your PREC. You can have another company that's associated with your PREC, let's say, right? And you can loan some funds over to your PREC, or you can pay it or to your holding company, or you can pay a dividend up to the holding company and use that company to invest in real estate. Okay. But if you have that company and you're investing in real estate and you're doing some flipping, and you're buying a property and you're immediately selling it, right? You're doing a quick paint job and you sell it right after, right? So let's say you make $100 grand on that property. Okay. If you make $100 grand on that property and you held it for a small amount of time, I mean, there's a bunch of factors you can look into actually classifying what kind of property that is. But if you were to sell it a month later, you just did a quick paint job, you didn't do much, and you've been in the business of flipping these properties before, then that's not really a capital gain to you. That's going to be business income, like we were saying last time. So that's going to be taxed at $100,000. It's going to be taxed at full business income rates. So if you've already used up your $500,000 small business deduction with your PREC, then you're going to pay 26.5% on that full amount of the $100 grand. So you're going to pay $26,500 of tax on that $100 grand of income you made, which is still a substantial amount on that, right? Whereas if you're buying an investment property, like a rental property, and I was saying before, and you have that rental property and you own it for 20 years, and then you go and sell it, that's like a capital property to you. So when you sell that, you're going to sell that for a capital gain. It's going to get taxed at 50%. So let's say you made $100 grand after 20 years.
A lot of money there, right?
Yeah. But let's say you made $100 grand after 20 years. I mean, we're probably not talking about Toronto real estate, but if you make $100 grand of appreciation after 20 years, now you're only paying tax on 50% of that gain. So you're only going to pay 50% on 50%, which is just 25%. Correct. So you're only going to pay 25 grand on that 100,000. Right. And there's some other mechanics that get funds out tax free the other side, let's say, right? So there's that. And then there's also, if you have the investment income gets taxed. If you have a rental portfolio, the rental income gets taxed at the high investment rates as well in the corporation throughout the time. So it depends on kind of what property you're investing in, and there's obviously different rates of tax depending on what you do and what your character is.
So let's give an example. So, as a realtor, you're in the business, you're in the field, what a good property is. You advise your clients, that are in the business of maybe, fixing and flipping homes, they're paying the business rates and whatnot. So what a good property is, right? So a lot of times, I get a call from a real estate client saying, hey, I have a property here I want to close on with a partner of mine, and, we're going to do a fix and flip, and we're going to sell it and make a profit. So, a cool investment vehicle, which you can do is now you can kind of open up a new corporation with your partner. You guys can be 50-50 shareholders. You can use the funds from your PREC that you've accumulated and paying at the low rate of tax. You can shoot that over to the Flipco, and you can do your buy and flip within that corporation.
Yep.
And like Matt was saying before, because you're in the business of flipping, that's active business income. So you're going to pay at the low rate of tax. And the biggest benefit of this is that because you're doing, let's just say you do this investment vehicle, this Flipco, with an unrelated third party, your partner is not related to you and whatnot, because the rules do get complicated. That Flipco will have its own $500,000 small business deduction. So essentially, any profits that you make on that fix and flip, up to $500,000, will be taxed at the low rate of 12%.
That's pretty good.
So you'll get two small business deductions within your thing, right? Is that what you're saying?
Yeah, you get two small. So your PREC will have its own small business deduction.
But is there a certain amount of time that you have to pay the PREC back? Once you take out the money from the PREC to give it to the Flipco?
No, it's you just lend it over, right? And
you just lend it over?
Because it's an unrelated party, if you don't want to charge interest, you don't have to charge interest. So
as long as you're not taking it personally out of you're lending it to another corporation. So it's not being taken out personally, it's just going to another corporation that you own.
Yeah, and now a common pitfall of that is what you have to be wary of is that now let's say you do that same sort of investment vehicle but with a spouse, and you own 50% and your spouse owns 50% of that corporation. Now because you're doing it with your spouse, you're related, you're gonna have to share that $500,000 small business deduction between the Flipco and your PREC.
Got it.
So just make sure when you're setting up these investment vehicles and you're setting up this corporate structure that you're always, consulting an accountant and a lawyer to make sure that you're properly set up. So there's ways around that, maybe you can multiply your small business deduction. Because the biggest benefit of a corporation in Ontario is when you start paying tax at the small business rate of 12%, up to $500,000. But if you can multiply that, right, through different investments and whatnot, that's where you get the true benefit of, incorporation.
Yeah. So like Mark was saying, if you partner up with another arm's length guy or a few other arm's length guys, you may be able to multiply that 500,000 over various corporations. Whereas if you're doing it with your spouse or with another family member, you might have to split that 500,000 that you're using for your PREC.
Right.
And you don't have access to that anymore. Let's say you already have it fully maxed out. So always consult a lawyer and an accountant when you're especially when you're structuring stuff. It's always better to take a look at stuff beforehand than it is to go take a look at it after and come to me like, hey Matt, like I made this corporation with my wife, and we're gonna have a big advantage from getting the access to the small business deduction. And I have to tell you like, oh no, sorry, you can't use your small business deduction on this. You're gonna have to pay more tax. And then it's never a fun conversation after you've already set it up and you think you're getting a benefit, and I gotta go and tell you, hey, this is not really a good idea because you're gonna get the CRA is gonna come and challenge you on this. It's not correct.
Matt always brings the bad news.
Yeah, I'm always the bad news guy.
Listen, it's always bad news when you got to pay tax for sure, especially at very large sums. But at the end of the day, the good news is that means you're producing and generating some good income, and your business is thriving, which is what you want, right? So Uncle Sam is always going to keep knocking, and that's what those are. Two guarantees in life, right? Is tax and death. So Uncle Sam's coming, but I'll tell you that much, and he ain't gonna stop until he gets what he wants, and he wants his little piece of the pie.
For sure.
Which is great, and I'm just making some joke out of it, but at the end of the day, tax is part of life, and it's something that we got to live with and understand that we all have to contribute towards that, because there's a lot of infrastructure and development that happens through different municipalities of government, and we need to do that, and that's why we have a wonderful healthcare system in Canada that many countries would wish to have, and it allows these opportunities. But I look at PRECS for real estate agents that are watching the show and that are new within the business and haven't done so yet, or maybe you're a veteran and you're still maybe not set up a PREC for yourself. Ideally, when you're listening to the show, you'll understand why it's very important for you to do it, right? Even if you weren't a real estate agent and you wanted to start a fix and flip business, or you wanted to start a wholesale business, or any type of business itself, you're never going to keep, especially for liability issues, where if something happens where you're in a litigation issue for something, that you did through that business. If you had that business as a sole proprietor, you have a lot of liability that's going to be held personally versus the liability that the corporation would have, correct? Mm-hmm. So if we can just kind of tap on a little bit of that liability that is also a huge benefit, and how you are more protected through the PREC. Let's say something happens, God forbid, and a real estate agent's driving, showing a client to go see a property and gets into a car accident, and something happens to the client in the car, or and now all of a sudden that client goes and sues the real estate agent. Can they now go after just the PREC, or can they go after them personally? I know it's a legal question, this may be offside for you. It's a little raw question.
But lawyers right now are
looking at us.
We gotta be careful.
Don't talk,
I gotta be careful.
Yeah, I gotta be careful what we say here.
Yeah, we gotta call our lawyers.
Sure.
No, but it's a good point. Like you said, you have to assess the legal implications. I mean, the lawyers are great for that, and they'll always provide you with the correct answer when it comes to legal liability and the corporate veil and all of that. But when you do have a personal real estate corporation, like, you're still somewhat so it's very similar to doctors and lawyers, right? You're still professionally liable personally, right? So if there is any negligence related to you being a realtor or something that you've done throughout your time as a realtor, like, you may still be personally liable for your realtor business, right? Whereas if you do have a corporation off to the side with some investments and whatnot, that might be a little more safeguarded than it would be if it was personally held, let's say, per se. But that being said, I mean, it is always, whenever you're trying to set up these, we always involve lawyers in the setup process to ensure that if they do have any questions about legal liability, we involve the lawyers and make sure that they're always taken care of, and there's no like, call it hole cracks that the legal lawyers will be able to take care of.
Yeah.
I mean,
and you brought up a good point before, Nick, and you said how there's two guarantees in life: death and taxes, right? So now I think now it's a good opportunity that we start talking about how can you plan for that death tax? What are some sort of investment vehicles or some sort of corporate structures or estate stuff that accountants and lawyers can kind of set up for you so that you can plan for your death tax.
Yeah, and listen, we can run a whole episode on that, which I think will lead to this last part of this podcast. Will lead into our next episode, where we are going to talk about the estate taxes that are very popular today and very common questions that there's a lot of need to understand how that works and different ways that people can benefit and protect themselves through the process for the next generation that you're going to leave that wealth to, or your real estate portfolio to. But why don't we just kind of tap into that a little bit and really understand retirement and estate opportunities. Matt, maybe you want to dabble into that?
Yeah, definitely touch on that. So yeah, there's always tax implications. We were saying earlier, there's always tax implications to take care of and take a look at and make sure that you're always factoring it in. But there's obviously business decisions too, right? So sometimes it's more important to, like, you want to take a look at your tax implications, but sometimes if the business sense means go ahead and take that venture and do that business opportunity, sometimes the business opportunity, you might not want to factor in too much of the tax. You know what I mean? It might be, it's sometimes better to just, what's that saying that one of our partners always says about the tax tail wagging the dog? You know what I mean?
Oh, yeah.
Don't let the tax tail wag the head of the dog or something.
Eventually,
like that. You know what I mean?
The point is that eventually you're gonna have to pay tax somewhere down the line.
Yeah.
So you can't avoid tax. It's just now how can you plan for tax so that eventually when you pass on, your kids are going to be left with this investment portfolio, real estate, shares of a corporation, and your estate is going to have to pay the tax. How are you going to come up with funds? Who's going to pay the tax?
Right.
And you don't want your kids to start, selling off your real estate that you've taken, 30 years to build. You don't want to start liquidating your assets. You want to be able to keep your hard assets while also being able to pay the death tax.
Yeah.
So how do you do that? What are some of the ways that could be done? Do you want to get into that?
Yeah. We'll jump into that. So with estate planning, there's vehicles that you can kind of bring into place that will allow you to defer something called the death tax, right? So essentially what happens when you pass away, there's a death tax you're gonna have to pay. So all your assets on death, there's a deemed disposition of all your assets. And that deemed disposition happens at fair market value. So if you have shares of a corporation and there's a bunch of real estate in there and you bought it all at cost, okay? When you pass away, there's a deemed disposition of those shares in that company. Okay, so if the corporation has all this real estate built up in the corporation, and there's a lot of future growth that happened in there and a lot of appreciation. Now, when you die, that company might be worth, let's say you put $1 million into it, and now 30 years has gone by, and God forbid you pass away, something happens, and now it's worth $10 million. Okay, so those shares are worth $10 million. So when you die, there's a deemed disposition on those shares. So you're gonna have a capital gain on whatever your funds you put into the company or whatever you capitalize the company with, and the fair market value at that time. So there might be a $10 million capital gain to pay, let's say. So who's gonna pay that tax, right? And who's gonna have the money to pay that tax? So you'll need the funds in that corporation to pay that tax bill, or you're gonna leave your kids having to fend for themselves and look for money to go pay that $10 million tax bill if they don't want to dispose of these properties. And that's you've built this wealth for your kids, and you have these rental properties that they mean value to you, they have sentimental value to you. You don't want to go dispose of those just because you need to pay this tax bill now, right? So there's something you can do called an estate freeze. So in the context of PRECS, if you had this PREC and you've been making $500,000 every year and you never took out too much money and you moved it over to an investment company, now you have the investment company has the real estate. So if you think you're going to have this real estate that you put some money into and you bought it at cost and it's pretty cheap right now, maybe we're in a lull in time with the real estate market and the values are lower than what you think they should be, right? You can freeze that value at, let's say, $1 million of what it's going to be today. And maybe when you pass away in 20, 30 years, it's going to be worth $10 million, right? So that growth today that you have in it, let's say there's $1 million of growth, that growth relates to Nick. Okay, so Nick has that growth. So now Nick freezes the value of that corporation, and Nick now knows that when I pass away, that there's only going to be tax on that $1 million. So you know where your death tax is going to be. You've already figured it out. And maybe you could get that life insurance policy that helps you pay that on death. You get a death benefit that'll pay that tax. Right. So your kids don't have to worry about it. The last thing you want to do is put your kids in a position where they got to go sell off some assets, like I was saying before, to pay this death tax bill. You don't want to put your kids in that position, right? So you can freeze your value, and now you can bring in something called, let's say, a family trust, or you can gift the shares directly to your kids. You can bring a family trust or gift the shares, and the benefit of that family trust is you can still have control over those assets if you bring in a family trust. So Nick, you can go be the trustee of that company of that trust, and then your kids are the beneficiaries of that trust. So you can decide, okay, who you want to give the funds to. I mean, evenly, however you plan to disperse it, you have that decision per se before you go and disperse that to your kids. So you have a trust now, and now the trust will be the owner of the common shares of that investment corporation you have. So now all the future growth, so you've frozen at $1 million. Now, come death, there's been $9 million of appreciation up to that 10 million, let's say, right? So in a situation where, like I was saying, now you've frozen, that $9 million, there's no tax to pay on that $9 million. That $9 million is with your kids. So ultimately, when they pass, they're going to have to pay tax on the appreciation of that $9 million plus future appreciation, let's say. So you've estimated your death tax bill, and you've taken away the situation where your kids have to fend for themselves and figure out how to pay that. So you now know how much to pay on death, and you can plan for it. Whereas if you didn't do that, now you got to go and figure out how to pay that $10 million kind of capital gain on your estate.
So what's the benefit for the CRA to give you a tax freeze then? Why would they allow that? Is it just...
Well, that's just planning for death tax.
That's just planning for death tax.
Yeah, at that point. It allows you to freeze your value today while still maintaining control. Because a lot of times too is like, we advise our clients, they've built up this real estate portfolio of, let's say, $10 million today. Right. And it's like, what are you going to do in 10, 20 years when you pass away? I don't care. Like, I want to control what I own. I want to control. I don't trust my kids. You hear that all the time. I don't trust my kids. I don't trust my kids. And I get it, right? Yeah. But what Matt was saying before, there's ways you can structure it, or you can reorganize your corporate structure where you can still maintain control of your corporation while freezing your value today. It's just planning for death tax, because the last thing you want to do is leave your children with this estate
burden
but this large tax bill, and it's like without liquid cash to pay it. How are you going to do this?
And the best way to do that is through a tax freeze.
Well, exactly, through tax and estate planning. So I mean, tax and estate planning doesn't start when you turn 70 years old and you're like, okay, I should start thinking about it. Tax and estate planning should start very early on. Very early on. It should be a conversation when you're even incorporating your.
It's like life insurance.
It's like life insurance. You should always have a plan in place for later on, no matter what. You should have your wills in place. You should always have estate planning in mind with any transaction you're doing, right? So you don't want, the last thing you want to do, like we're saying, is leave your kids with that burden. So we see it all the time where some guys haven't done any estate planning. And then it's like, okay, you get to a point where you get sick or something happens, and it's almost like, not that it's too late, but it's like you could have done some estate planning beforehand to defer this tax that you're going to have to pay right now, whereas you could have avoided this altogether. Right. You know what I mean? Or not avoided the tax, but prepaid it or passed the future growth and have some more of that income tax deferral that you can benefit from. So, I mean, we see horror stories all the time, or people just, I'm going to just put my kid on title and give him beneficial ownership of this property tomorrow. and not consult anyone.
But there's still now you're paying tax today.
And then you're paying tax today. Well,
Yeah.
you should have paid tax, right? So some people, and the problem is you don't know what you don't know. So if you don't consult anyone, you could be doing all these transactions. I mean, maybe you're getting away with it. Maybe like nobody's really looked into it, but you really want to you want to sleep at night. You want to be able to know that you've gotten the best advice you can on all these, especially if they're big transactions, right? I mean, not that a small transaction you wouldn't, but for a big transaction, like you want to sleep at night and know that you've done your due diligence, you've taken care, you've set aside your money for tax purposes, and now you don't have to worry about what's going to happen with my kids later on down the road. Because we see it where people pass away and they don't have anything in place, and then now you're dealing with their kids where you used to deal with their father, and it's like that trust level is not there. You're trying to explain all this, and you have a lot of estate like fights between kids and brothers and sisters and all, and it's just something you don't want to get into after having that legacy of life, where it's like you don't want to pass that on to your children, and you just want to have it all set in stone through your will, through your estate, and you know what you're passing on to each kid, and they can just go on with having that great
and you
relationship
don't want to
they
leave
have,
them with
right?
any burdens or tax
Exactly.
burdens, right? Where
Yeah.
they're stuck with all that, paying all that tax as well, and there's all this stress that comes with that too
Exactly.
as well, and complications
Absolutely.
that could take place. This is awesome, guys. We've made for a great episode today. I think we need to build on the estate planning for next episode, because I'm sure there's going to be a lot of questions even through our viewers that are going to want some advice on that. But if there's any questions that you may have, please reach out. We'd be glad to help. If somebody needed some of your services, guys, what's the best point of contact to get a hold of you guys?
Well, we have our website, valentepacitti.com. We also have our Instagram account. You can reach out to us. Another thing too is, even if you're an individual who's a real estate agent and, you kind of just want to figure out, does it make sense for me? We can sit down or have a quick phone call, and we can run through sort of your numbers, and we can advise you whether it does make sense preliminary.
Yeah.
But you can get in touch with us via our website or
You can email us at info@valentepacitti.com. Shoot us an email. I mean, I know for sure after we close this conversation and close this episode, Nick's going to be calling us about estate planning anyway. So we know he's going to be the first call.
How did you know? I'm like, while you guys were talking, I'm like, what? Okay, that's our next move. Like, there's a lot of stuff, moving parts that we've done, but now that we have to definitely work on that. And that's our next move for us too as well. But for those viewers that are listening, when these guys hit 500,000 views, there was a lot of people through different countries that actually seen that clips of you. So I want everybody to understand that this is a Canadian-based podcast. A lot of the tax advice that these guys are that are giving advice on is for our for Canada itself.
Yeah.
So
That's funny.
please, if you are American right now, I don't know if the same implications
call
do
Uncle Sam.
just call Uncle Sam or get a good tax accountant over there.
Yeah.
These guys are based in Toronto, Ontario. So if anybody's listening in Toronto, Ontario, and needs some wonderful accountants to help them through the process of their tax planning, give them a call. Again, Marc, Matthew. Glad to have you guys on the show again, man.
Thank you.
For sure. I mean, and to be said, it's not really tax advice. I mean, we're not construing any advice on anybody else. If you have any questions, feel free to reach out to us. And it depends on your situation. We'll take care of everything. We'll work with you.
Awesome.
Looking to buy or sell? Call a team you can trust. Don't believe me? Our Google reviews say it all. Put us on your lawn, your house will be gone. TheOPteam.com.